Welcome to the Future of Supply Chain, presented by Dynamo. Each episode, we sit down with leaders in the industry as we build the future of supply chain together. Let's get into the show. Here's our host, Santosh Sankar.
It's good to get the besties together. We've all been doing supply chain stuff for at least a decade now, so it's always fun to get the crew together. And we won't do intros. Most folks know this crew, but maybe a quick, and I'll start with you, Santosh. Just say hello in case we got any new listeners out there.
Hey, folks, I'm Santosh Sankar, co-founder, managing partner at Dynamo Ventures.
All right, Stallman, I'm looking at you.
Hi, everyone. I'm Chris Stallman. I'm one of the managing partners at Fontinalis Partners.
All right, and best for last, Julian, of course. Bring us home. Bring that energy.
Hello, Julian Counihan, partner at Schematic Ventures.
Awesome. All right, guys. Well, we just went and Chris, you and I were talking a little bit before we kicked this off. Travel season, man, we're talking Modex, Manifest, Ford Fort Worth, TPM, just too many supply chain conferences out there for the Blitz. So highs, lows, everyone wants to hear how things are going. I think I saw more people than ever. I mean, what do you know? We even had some growth investors showing up in a lot of this stuff, which is great. But what was the buzz everyone was talking about other than I'm pretty sure our Manifest event this year blew all kinds of fire codes, and our line was out the door, which was great. I don't think we're getting invited back to that space, but we shall persevere and find another one. But what's the Blitz been like? Has everyone kicked off the year?
Yeah, I'd say I'm not really a conference warrior, but some of those events that kick off the year, the Manifest, and then I also go to the Consumer Electronics Show. Certainly had it. Certainly had a higher energy and vibe to it, as hopefully is a good sign that budgets are starting to open up a little bit. I think this time last year, I was hearing from a lot of parties that they were sort of constricting their budgets, especially on the technology spend. And right now, it sort of felt as though people were back out there hunting. And certainly at Manifest, I saw a mix of new attendees as well, both on the investor side and really a very large shipper contingent as well, which I think was a welcome addition from an attendance standpoint, getting more of the customers there for these startups to mingle and interact with.
Always trying to get the shippers there. It's been the challenge. I agree. I think especially at Manifest, because didn't they have 2 bays this year? It expanded like a whole nother half. So shout out to Pam Simon and that crew. We'll definitely be back at it again next year. Santosh, sorry, cut you off. Where were you going?
I definitely agree on the shipper part at Manifest. This is probably the first year where I didn't try to cover all these things on my own. So we split it up across the team. And as we were reflecting on kind of Q1 end of conference season, I think the general tone that everybody walked away with was, it feels like there's this cautious optimism. People were licking their wounds for the most part last year, or rather looking for normalcy. I wouldn't say necessarily licking one's wounds, but kind of the punch bowl was taken away. People were hungover and they were trying to recover and figure out, okay, what does the world look like? What is this sense of stability we can go operate in? So that certainly feels like it's been conveyed through the conference circuit. And it corroborates a bit of what we're seeing through the portfolio as well. So makes you feel good, kind of going into the balance of 24.
Yeah, I would definitely use the word optimism. If anything, from our happy hour, it was great. We're gonna have to figure out how to go bigger next year. Thanks again to Prologis. They get a shout out for joining us this year. But there was a ton of optimism in the room. So I don't know, Julian, what were you seeing across you're a road warrior. See all those LinkedIn posts with airplanes in the background.
Yeah, no, it was 6 conferences this start to the year across supply chain manufacturing. And this is tough because Santosh and Chris are my heroes, but I'd like to violently disagree with them.
Go for it. Go for it.
Retail is not back. E-com is not back. Inflation is persistent. The Fed has signaled they will cut slower and steadier than the market expected. I think that mortgages, staffing, spending from e-com and retail, and I think the retailers were beaten up, and I don't think they're back. Now, beverage, pharma, cold chain, healthy. But ecom retail struggling outside of some fast movers, Temu, Shein. And I don't see, I looked, I looked everywhere. I looked under every rock and I didn't see any green shoots. I would love green shoots, but I didn't see any green shoots. So I think freight rates across every mode, air, maritime, rail, no matter what, you look at the charts, they're not moving. There's like a little blip, but not what we want to see.
All right. So unless there's any rebuttal here, I'm going to take Julian's thread of things still are tough waters out there. I want to talk about the venture side of funding all of this innovation, right? Not just the corporates themselves. But any go backs here, Chris, Santosh, and as the heroes of the day?
The only thing I would say on if we bifurcated and look at consumer demand versus industrial demand is not great by any means. I think a lot of people through last year were working on backlogs. There are a lot of proactive cost management measures that were put in place. It feels like that's going to be the norm through most of this year. Yeah, we're not growing like gangbusters on the consumer side if we look at e-com, but it's just kind of gone back to this 2019 trend line. Like you have this blip and you normalize that out, you're kind of back to where the original trend line was directing. And having that gives us at least some confidence as to we just need to have normalcy and reasonable expectations. So the fact that people feel like there are reasonable expectations to be had, and yeah, it may not be growth or gangbuster growth, that's okay. At least we have some parameters now we could work with. Because last year it was really felt like who the hell knew? So
Yeah.
that would be my only statement.
Yeah, 2023 was a pretty hard reset for a lot of companies in this space. And I don't think anybody necessarily expects 2024 to be off to the races per se. But I think there's a degree of finding some stability in the market. And I think we'll get into this a little bit as well. But, you know, when we look across our portfolio and we look across companies in the ecosystem that are selling into this space, I think they are selling into it with a little bit more of a tempered viewpoint and a cost structure that matches that. And it allows them a bit more optionality in how to play this over the next couple of years than what they had before entering into 2023. They thought it would be a good year, and it just quite honestly turned out to not be a great year.
Yep. And maybe I'll take that kind of tempered discussion into, as I was preparing for this, a lot of folks, we are a bunch of VCs, usually associate negative value when you have 4 VCs on the same call. But that said, they want to know what's happening from supply chain VC perspective in 2024. So I got out that handy PitchBook Q4 supply chain tech report. It's pretty good. At least gives a little pulse each year. And the numbers are not pretty. It's negative 40.5% year-over-year deal count volume decrease, negative 48.8% year-over-year deal value decrease, et cetera, et cetera. The sky is falling if you're just reading the report. Now, that said, and Santosh and I were actually in Fort Worth discussing the topic of all of this funding at Forward Fort Worth, which is a great conference every year. Shout out to the Hillwood and the Pro Jane team. And the big takeaway, though, there was an optimistic tone to it, even though there may be a tempered part of it. And so, you know, for this discussion, but right, one could argue that enormous amount of funding that we're now coming back off of on a percentage basis, maybe it was overinflated volume because of things like crossover funds, et cetera, you know, call it whatever you want, tourist investing. But the quality, or at least I know I'll speak for myself, the quality of founders, I'm seeing start new cos, being able to raise capital because they've got good growth metrics, people are spending for the software. It does encourage me going into 2024. So I'm curious how each of you guys are seeing it from the lens of a venture capitalist, all these stats and all these numbers decreasing, but we've got a job to do in 2024. So where's everyone's heads at?
I'm excited. I think multi-stage will pull back from this category, and that will create a healthier investing environment. You know, I would just be guessing, but I would say a significant percent. I don't know what the percentage would be, significant or not, but there are many companies that would still be here today if they were not overfunded in 21 and 22. And I'm excited to get back on that healthy investing track. Even if supply chain capital drops to the level of 2017, those were incredible years to invest in the category. When founders who were truly inspired by the problem they were solving had to start this business and no VCs wanted to touch the category,
Yep.
that was an amazing time for me and for Schematic. So I'm looking forward to getting back to that point. There were a ton of growth investors at Manifest. My first question for them was, what's the last supply chain company you invested in since we met at last year's Manifest? And it was always zero. So I'm hearing and seeing multi-stage pullback. I think there will always be healthy follow-on and late-stage capital for this category. But the definition for me as far as healthy late-stage capital investing into supply chain is capital that gives these companies the time that they need to reach their targets and build sustainable business models and all that kind of other stuff, as opposed to sort of foie gras startups with way, way too much money.
Fair. And maybe the question is, are we done with the correction yet? Guys, we all went through 2023, right? There's all kinds of bridging and figuring things out because we're all trying, but none of us are off the hook ourselves. But are we done with it? Because my opinion is we still have some triaging to go, even though we're maybe closer to the final mile, to use a logistics term. But open discussion.
Yeah, I don't think we're done with it. And maybe just building off of Julian's point too, I think we saw with a lot of multi-stage funds that they forgot the freight logistics supply chain. This is a cyclical space. And as we all know, when you have a cyclical market and the tide goes out on it, it exposes kind of the naked seabed for what that's worth. And I think what that also does is it sort of allows you to see who the companies are that can execute in all business cycles. So that's the optimistic viewpoint that I take on this. Overall, I don't think though that we are through some of this transitional pain, if you will. I think we're still going to see some of it play out in 2024 because you look back and you have a lot of companies that raised in 21 and 22 and they've cut burn and they're still deploying the capital they raised in their last round, but they're going to have to go back out to market and they're going to have to reset the market's expectations. And I think a lot of that's going to happen in 2024. Some of it already happened last year, but I think the next batch of it will likely be this year and maybe even early next year as well.
What are you seeing, Santosh?
So I echo what feels like a continued sense of cautious optimism. And maybe where the caution is coming in is a bit to what Julian and Chris are alluding to, that that last shoe hasn't dropped, right? So there are companies that have tried to take proactive measures, but still need to at some point show up to raise another round this year. Now, they may or may not be able to do that, even if they're open to resetting their valuation. At which point, I think we're going to see a lot more companies shutter or artfully exit stage left by December. I think that's when I'd probably feel a bit more comfortable in saying that we've overcome or this correction has concluded. Now, what I do think is happening in the market is we frankly are doing more earlier than we are kind of at seed. So are open, want to do more at pre-seed, seeing more interesting things at pre-seed. At seed, what we're running into oftentimes there's still a bit of tension around what is the right traction or the right things and qualities, traits you show up with in order to raise a seed round. And also, what exactly is a seed round these days? There's probably one camp that thinks it's kind of a 3 to 4. There's another that bloats it kind of closer to 6. That was very much the norm in 2020, 21. I'd much rather not worry about that, because if I'm going to get into that, the thing I'm worried about is Series A investors kind of volumes are still down, valuations are compressing. So we see a lot of opportunity at the pre-seed. That's also kind of very formative. It's what we think we are well qualified at. And frankly, I personally also enjoy. So my hope is that activity that you alluded to, Ty, to open up this kind of segment as to we're seeing better people show up, salt of the earth type entrepreneurs. My hope is that continues. That continues.
Yeah, and maybe we've seen more the volume investors at some of these events, some growth. Julian, love how direct you are with your conversation openers. Those would be some fun coffee chats. But really, I'm curious how you guys think about it, and I'd say it humbly. But between the four of us, we probably could network into any supply chain company and/or investment group. We just spend all our time here. Do you guys see there a pullback in what is really important to all of us, which is downstream capital, even if they showed up to conferences, but maybe just take the growth investors out of there? But Santosh, you mentioned, what does seed mean now? A's in a really tough spot. How are you guys seeing what are people maybe that assigned a partner there to go deeper on supply chain for a couple of years, and then maybe they've pulled back, and, AI generative is where I'm going to spend all my time, or however you want to define it. How are you guys thinking about non-growth, but kind of in that middle stage where we're looking for that downstream capital? Good thing with the correction, or do we need more jumping back in?
Call Chris Stallman. I'll write you that.
I've got a few viewpoints on this. I mean, I think, when you ultimately look at this market, I have seen more of the white space fill in a few segments. You do get some spaces, maybe that's the next TMS or WMS or whatever you might have, that starts to split the market a little bit thinner. And I think some of the growth oriented funds have, struggled to find the companies that are showing the true metrics of breakout at the scale they need to fund meaningful checks into these businesses. And a couple of years ago, they were moving in and giving companies a credit for kind of a round ahead of where they were actually at. And I think it's been more of a return to saying, let's focus on true Series B metrics or true Series C metrics. Where are you at? And the frank reality is that after a bit of a soft 2023, it just doesn't give a lot of companies in their universe at the moment for them to really lean into on the growth side. I do think, though, that when we think about themes, digitizing our industrial base and reshaping the way people and goods move is a multi-decade investable theme that will continue to attract capital for the right companies, but there'll be some disruption kind of along the way. I do think that there are times where sometimes the growth-oriented investors get a little carried away with carrying momentum on certain spaces. I mean, we saw lots of dollars flow into digital marketplaces. We saw lots of dollars flow into a few of the visibility players that were showing really interesting metrics, and everyone's sort of resetting and saying, well, wait a second, maybe those didn't work quite as well as I had hoped. Now I need to figure out what's next, and what's next perhaps hasn't hit the revenue thresholds I'm looking for at this point. So I think there'll be a little bit of them sitting on the sidelines for a period of time, but I talking to a lot of these groups, I think there is very much a commitment and an interest around the theme that capital will ultimately be there. It's certainly not fleeing this concept or this theme overall.
I think Ty, the way you asked the question is kind of the way I've taken it is kind of the Series A, B land, right? Before you're kind of in the proper growth world. I think the one nice thing is the tourists are gone. I actually think that's a positive. A lot of to what Julian said, like the sector requires a lot of patience. The one thing that people have certainly learned is that domain matters in the sector. For example, one does not get valued or multiples on their gross revenue or GMV, whatever you want to call it, which ultimately led to the overvaluation of a lot of these marketplaces or digital brokers, whatever you want to call them. Who is left now? Frankly, the types of people that I think about, talk to, trade notes with, if anything, have doubled down on their thesis and the work they want to do, even if they might be generalists, right? But they have this interest in the sector. And some of that, might require them vocalizing, the bar's moved, Santosh. Like, you need to go back to your portfolio and help them recalibrate what a great Series A looks like. And by the way, business model matters too. Not all revenue is SaaS or treated equal. And perhaps for a period of the last 5 years or so, it felt that all revenue was equal, and that in fact is not true. So there's a little bit of kind of using the scalpel and being a bit more well calibrated as a Series A investor. Now, what does that mean? It might take longer to get these companies to that stage. It might require a level of IR and trust building well ahead of a round. But I think all that's good. I was going back to the fundamentals and not get carried away.
The good thing about this particular market and companies that are being funded today is that they're on a trajectory where, with the new targets that Santosh mentioned and what Chris mentioned, which is the problems of the Series A market are not the company's problems. Like, if you've got great margins and you're default alive, and every Series A investor, disappears off the planet, you'll still find capital and you control the destiny of your company because you've kept your eye on cash flow and margins from the start. And pre-seed and seed companies being funded and starting today start with that mentality. So when I talk to seed companies, I think, run a great business, keep an eye on cash, keep an eye on your margins, and the Series A fund problems are not your problems. Like, the capital will be there if you build that great business.
Yeah, and I think it's a great point, because I don't think Bain may have released the latest of its annual private equity report, and that slide that talks about dry powder that a lot of VC Twitter talks about. There is more dry powder on the sideline in venture than ever before. I think the collective dry powder in privates was like 2 trillion something. I don't remember the number. And so I love your point, Julian. If you're building a real business, there will be capital for you. Keep the eye on the prize. So agree with you. We could talk about venture stuff all day. I'm going to progress us forward. We all spend a lot of time in one subsegment if we can. Anyone that knows how to define supply chain, please let me know. But one subsegment of it is freight. And my goodness, I think, Julian, you mentioned it's just never ending cyclical, or someone did. So let's chat about the freight market. I got some feedback for us to discuss it ourselves as well. So the way I'll do it, let me frame in some challenges and some optimism, and then we'll have the debate here. So the challenges, I think we've all seen the news. UPS cut 12,000 jobs. FedEx is doing restructuring. I think their goal is to take $4 billion in cost out by 2025. CH Robinson shares were down 4% after their Q4 earnings. Schneider National is down 2.5% after their year-end earnings. And quoting the RXO Chief Strategy Officer, Jared Weisfeld, I thought he had a good quote. We're seeing some signals, but we're not yet at that pace that's required to bring that load to truck ratio above where it is right now, which is about 3-to-1. The long-term average, according to RXO data, is about 4-to-1 where we need to be. And you'll start seeing that spot market reemerge when we start seeing that metric punch above its weight. End quote. There's still too much capacity in the market. So that's kind of the challenging part of it. On the optimistic side, I give a shout out to Craig Fuller and the FreightWaves data crew. They recently outlined a few things that I think are promising. OTRI, a metric we all know, but OTRI is defined as outbound tender rejection index. That basically is a tender rejection that's now above 5%, which, if anyone's not familiar, it really measures truckloads rejected, which means that it aligns with carriers rejecting if they've have better options elsewhere, right? So good thing for them. And 5% is much better than the low single digits we were when we kicked off the year. The second data point they brought up was truckload spot rates have hit a 6-month high, and usually truckload rates right now in Q1 are far below Q4 peak rates. So, et cetera data out there, reduced retailer inventory levels. Julian, I know you mentioned they're still struggling, but they have at least got inventory into a good spot per se. Yes, the Fed did come out today and say it's going to be slower than they'd like, but they still have said they're going to maintain the rate cut. Geopolitical tensions causing more reshoring, nearshoring, et cetera, et cetera. So I get off my challenges and optimism soapbox. What is going on in the freight market today? Is it bouncing back, or do we still have a long way to go, guys?
Yeah, I think the freight market is one of, supply and demand. And what we saw, especially during COVID, was there was a tremendous demand and not enough supply. It pushed spot rates significantly higher, and it created this illusion that running a trucking company was quote unquote easy and profitable. So you had a lot of capacity come into the market in a relatively short period of time. And it takes a really long time to flush that capacity back out of the market. I know the FreightWaves team and Craig Fuller talk about this regularly, but one of the things that they track is operating authority rescissions, essentially how many operating authorities are given up by the trucking companies as a sign that they are leaving the market. It's not clean and linear. It doesn't happen just regularly throughout the year. Certainly there is some of that, but typically what you see is at the end of the year after a peak period, that's when people start to leave the market. And we saw a fairly robust rescission data at the end of last year, but it's still, from a supply and demand imbalance standpoint, still looks like we might have another 9, 12, 15 months worth of excess capacity in the market. So it's going to take a little while before, we see that imbalance a bit more. I do think, though, that broadly speaking, the economy has held up. Certainly the consumer is generally held up okay through this. And so the demand side did not collapse. And, rates certainly are not what a lot of operators need from a break even and profitability standpoint. So we'll still see some of those parties leaving the market. But I think it's going to take another several months to a year before we start to see that truly balance itself out to kind of pre-COVID levels. And I think we were seeing some optimism in January with the rates going back up, but February kind of shifted a bit towards anemic levels again. So, just a sign that the freight market's not going to rebound aggressively. I think it's going to rebound slowly over time and throughout 2024. I don't know if Julian or Santosh kind of have other thoughts on that.
So nothing to add, but I was gonna jump on to Ty's list of foreboding news with Gucci issued a sales warning, which is gonna affect all of us this morning. No, but I mean, you've got luxury down to Dollar General issued a sales warning, but Gucci was the latest today. It's just daily retailers are forecasting.
That's right. Daily or Dollar General or Dollar Family, didn't they just shut down hundreds of stores on one side of the brand? Something like that. Yeah.
Yeah, lots of sales forecast warning. I mean, Macy's, everything. Every category of retail is getting hit. To add, and I would say those come before all the forecasts of the logistics and parcel providers. The parcel providers react to that, but it starts with retail.
My general sentiment as it comes down to trucking, to pull on Chris's thread, we saw data that there's something like 120,000 carriers that entered the market over the 2-year period between 2020 and 2022. By the end of 23, about 30,000 left the market. So you still have quite a bit of capacity that needs to leave. Speaking to some of our portfolio companies who are engaged in that market, they are seeing some of the carriers continue to leave the market. A lot of these are folks who came in thinking you can make a quick buck and realize like this shit is really hard, right? Like moving freight is not for me, which it's a really hard business, industry, profession. So I'm not sure whether we really get a sense of normalcy till towards the back of this year. The one thing I do think that we will get back to is the seasonality that was present in the freight market. Now, to what Julian said, your demand might be muted, so you may not have as tall peaks as you ordinarily do leading up to kind of the warm summer months or even the holidays. But the fact that you can start calibrating your operations to, hey, there's kind of this up and then you're back and then you're up again, like that allows for a level of predictability. And supply chain people are planners. They like predictability. They plan around that. And that way you can kind of at least calibrate some sense of a baseline and work from there, rather than everything's up and to the right, our hair's on fire, or everything's down and we need to go take really draconian measures in order to shore up our business.
Yeah. Well, if anything I've taken away from all of us is it's still a cyclical industry. There's still things we're figuring out. And if there's that much cyclicality and, you can look at earnings, you can look at whatever chart you want, it means more innovation is needed than ever still, in my opinion, to help us figure a lot of this stuff out. And so I'll use that as our segue to try to get in what was another favorite last year. It's March, so it's not really fair, but let's get our crystal ball out after all of these conferences and kind of from an optimistic perspective, what is it that you're seeing ahead in 2024 that can help tackle some of that, whether it's freight or more broadly defined, some of these industrial supply chain challenges? I would say for myself, kicking it off, it's almost like this thread of circa 10 years ago in this asset class, a lot of getting your data in order, a lot of just using that data to get moving toward digitization. Then we got into like some advanced things, call it visibility, people taking swings at TMSs, et cetera, right? We could all go down the list. What I keep hearing now from customers and seeing through some of my portfolio is this rallying cry of actionability. It's like, okay, I've done all the piloting and experimenting, and thank you, venture capitalists, for throwing everything over the fence to me. But unless it can make it actionable in economic terms, I don't want another ROI calculator. Yes, you need to do that, but I want to see some actionability out of all that software and workflow. Yes, it helps me with productivity and things like that, but help me make economic sense out of me buying that software and the action it's going to take. So that's somewhere I get optimistic about, because I think that probably aligns, maybe Julian, to your point of eye on the prize on margins and business metrics that matter for the end customer, not just your business alone. So, but where are the crystal balls for you guys?
So I'll mention two things. One, I think we are in the trough of disillusionment around autonomy in trucking. Seen a lot of bankruptcies and issues with regulation unrelated to the safety of these vehicles. But that doesn't change the fact that every day these autonomous vehicles are adding miles and miles and miles and getting better and better and better. I'm a huge Waymo rider, big fanboy here in SF, and in Texas, drone deliveries are happening every day. So as much as you hate them, I think attacking it through sort of a municipal approach to automation and automating that last mile piece is going to unlock a lot of margins in supply chain. And if you can ship things for that much cheaper, you are going to ship more things. So I think we're probably, gonna hold me to this in our heavy hitters 2027. But I think we're like 3 years away from unlocking autonomy, be it drones or autonomous trucks, autonomous last mile, in a way that will vastly increase the size of the supply chain industry. And on the other side, on more the data and the software side, I have spoken to just a ton of retailers and large industrial companies who have adopted Snowflake. Historically, they were never able to put all of their data in one place because it required unification, data normalization, and they just were not suited for that incredibly onerous process. Now, with data lakes and object storage, you could just throw all of these objects into a data lake without normalization. And now you have digital and API access to almost 100% of your data. So many of our portfolio companies struggle because they launch with this killer tool that pulls out an amazing insight, but how do we get access to the data? With Snowflake in place, I think that clears the way for a ton of new technology and software companies to launch and get past that integration problem immediately, to walk into that retailer with a 1 to 2 week integration process and start delivering. And so I think that changes the sales cycle in the supply chain software world. And I'm super excited about what that means over the next couple of years.
Unlocking the data is everything. Absolutely. Those are two good ones. Where are you at, Santosh?
So there are a few things that we're thinking about. The first is all of the geopolitical conflict that we're observing around the world. That's influencing certain tensions and work to be done as to, do we want to have certain supply chains exist in this part of the world? If so, which parts? How do we mitigate the risk? And how do we kind of manage through this change where we are what I call it and how I describe it is we're not trying to reverse globalization. I don't actually agree that like we're ending globalization or it's going to reverse. Instead, the way I observed it is through the late 90s into the early 2000s, they're just kind of this blunt force mechanism of the world's going flat and we're going to push everything to China, right? Now, as there's more nuance and understanding of what that means, there's a bit of an optimization exercise, if we could kind of view it in that lens, as to, okay, there's certain parts that we can't necessarily remove from China. And we also need to realize that some of these things are narrative. They're not necessarily truth. But those things that we remove, maybe it goes to Southeast Asia, maybe it goes to India, maybe some of it comes back to our neighbors in Mexico. And so what we've spent our time thinking through is what are all the trade and compliance implications around that? And our most recent investment very much, while unannounced, it kind of leans into that. And the one line that I have is similar to how lawyers win, whether the four of us close an investment or not. My belief is that kind of customs trade compliance people in this new day and age will win, irregardless of kind of where volumes flow from or what the item might be, because you still need to make sure that you're within the protocol of the customs code and the government. So that's one area that we're super excited by, and that's going to be enduring. Or at least for the next decade, we're going to be grappling with this issue.
And Santosh, can I throw in a data point here? Because that one is so spot on. Like we all watched this, but just so anyone listening missed it, in the fall of last year, Mexico overtook China as its largest trading partner, 15% of US imports versus 14.6 for China. That's a huge deal for anyone that's following it. And I am in the home state of Texas, so I got to give a shout out. The Port of Laredo, with all the border stuff that's happening there, it is our number one international gateway in this country, of where I think it was a plus 12% year over year growth of $28 billion in goods coming across. So if you're not looking at, to your point, Santosh, how the reconfiguration, right, the world is flat, may not become like just one way, but man, there's a lot of innovation there. So I'm on that train with you, Santosh, for sure.
And the other area is, listen, we've just come into a period where I think you said it, Ty. I call it "show me the money," and it's not just about ROI calculators. It's like practically how are we, in a secular way, changing the structure of some of these legacy businesses, logistics service providers, shippers, even carriers, as you kind of abstract that across the supply chain. And in order to really move the needle and not just do BPO or RPA on certain items within an organization, but fundamentally retool a business where it can withstand a level of scale with materially less cost. There's a lot of technology convergence that's happening. If you think about the white collar, and I think we'd be remiss not saying the acronym LLM or Gen AI during this conversation. It's to be seen how these businesses build defensibility and moats into themselves. But there's also a version of that we've all invested in, kind of the more industrial world, right? Around robotics and industrial automation. And I think that will continue to pick up, maybe not this year, but certainly we're optimistic that over the next couple of years, we'll continue to kind of see a robust environment and opportunity in and around that set.
Solid. Round us out, Chris.
Yeah, I think when we look at the supply chain space and the logistics space, I mean, certainly there's commonality across customer sets. There's some common challenges that they're looking to solve. But if you pull the Fortune 500 companies out there, nobody's running the same tech stack. There's a lot of vertical software that's been created over the last decade or more. And what we're really interested in is how to unify or de-silo some of those data aspects across that ecosystem. And so some of that is, unified APIs to access, for example, telematics across multiple platforms. As Julian mentioned, we're excited to see the capabilities of building workflow automation and insights and tools off of data lakes that we're seeing as well across a number of these parties, where they can sort of put it into a single source and then run their own business operations on top of that. I'd say the one other area that we are building and kind of refining our thesis around is the notion of enterprise risk management. And I think we've seen in a lot of supply chain disruptions that have come from kind of these 4, 5, or 6 Sigma events, but we're also seeing disruptions on these sort of like 1 and 2 Sigma, more regular, more recurring issues. And so, we're open to talking to any companies out there that are helping to deal with all different risk vectors at the enterprise level: compliance risk, financial risk, insurance risk, macro, climate, weather, regulation risk, you name it. And we're starting to see some really interesting innovation where services that maybe were previously only available to kind of the top end of the market are finding their way more down market into some more mid-market enterprises. And I think that's a big opportunity to kind of open up and expand, areas like, commodity risk hedging and the like as well across that ecosystem.
Awesome, guys. Well, some good hunting ground there. And I think we get to cheat since it's March 20th. So we can't really be that off for 2024 crystal ball. So, but Julian was already thinking, of course, the stoic MIT brain he is. He was already thinking ahead to 2027. I'll leave that to Julian. We got a lot of work ahead of us. As we all know, the supply chain still, talk about, I think I feel fortunate to be investing in this sector because a lot of challenges. We talk about that all the time, but that just means big, big opportunities for us to make a really big impact and do some venture returns for our LPs at the same time. So I'm excited. Let's get manifest planning going again. All the weight falls on you this year, Chris. So I'm handing the reins over, but we'll do this again next year, same time.
All right. Thanks,
Awesome.
Ty.
Thanks, everyone.
Bye, guys.
Thanks for watching. Follow us at dynamo.vc for all the latest episodes. We'll see you next time.